Hey everyone, welcome to the deep dive. Today, we're going to cut through some of the market chatter. We're looking at an indicator people often call the Swiss Army knife of technical analysis, MACD. It's really quite interesting because it can sort of tell you about a trend's direction and its strength all at once. So, yeah, let's unpack this.
That's right. And, for anyone really wanting to get a handle on market momentum and those directional shifts, MACD is incredibly valuable. I think what makes it so trusted isn't just the signals. It's also its ability to give you a sense of the market's, underlying conviction. It really helps you filter out a lot of that day-to-day noise.
Okay, so MACD stands for Moving Average Convergence Divergence. And what's really cool, like you said, is it's both trend following and a momentum indicator. Basically, it shows the relationship between two exponential moving averages, EMAs, of an asset's price. And traders use it to spot, shifts in trends, momentum changes, potential entry or exit points, that
Right.
kind of thing.
Exactly. And what's fascinating is how these three distinct parts work together. The standard settings people usually use are 12, 26, and 9 periods. And they use EMAs because they react quicker to recent price changes. Makes the indicator more responsive.
Yeah.
So first up, you have the MACD line itself. You can sort of think of it as the market's acceleration pedal. It's calculated just by subtracting the 26 period EMA from the 12 period EMA. Essentially shows you how quickly that shorter-term trend is pulling away from the longer-term one. When it moves up, momentum's building fast.
Right, the difference between the fast and slow averages.
Precisely.
Hmm.
Then there's a signal line. Now, this is a 9-period EMA of the MACD line itself. So it's like a moving average at that acceleration measure we just talked about.
Ah, okay. Smoothing it out a bit.
Yeah, exactly.
Okay.
So when the MACD line crosses its own average, the signal line, that often signals a change in the rate of momentum, not just that momentum exists. And finally, the histogram. This visually represents the difference between the MACD line and the signal line. This is like your instant speedometer for conviction. You see taller bars, that means momentum is really picking up steam. If the bars are shrinking, even if they're still positive, it suggests the market might be, running out of gas. It's a really clever way to gauge enthusiasm almost instantly.
Okay, so we know what MACD is and how it's built with those three parts. But the real power obviously comes from knowing how to use it. So what are the key signals traders are actually watching for?
Well, there are three main ways MACD generates signals. The first is what we call crossover signals. So bullish crossover happens when the MACD line crosses above the signal line. People often see this as a potential buy signal. It's like momentum's getting stronger, maybe ready to push prices higher.
Makes sense.
And the flip side is the bearish crossover. That's when the MACD line crosses below the signal line. Suggests a potential sell.
Okay, crossovers. What's next?
The second is the zero line cross. When the MACD line itself crosses above the zero line, that suggests the overall trend might be turning bullish. Think of zero as like the equator. Crossing above means you're entering clearly bullish territory. And if it crosses below zero, it signals a bearish trend, heading south, so to speak.
Right. Above zero bullish, below zero bearish. Simple enough.
Yep. And third, and this one's maybe the most nuanced, but also really powerful, is divergence. Okay, so imagine the price makes a new high, but the MACD indicator doesn't make a new high alongside it. That's kind of like seeing a car speeding up, but the engine's sputtering.
Yeah.
It tells you the underlying power of the momentum is weakening. It hints at a potential shift before the price actually turns down.
Ah, I see. So it's like an early warning.
Exactly, an early warning system. And similarly, if price makes a new low, but MACD doesn't follow it down to a new low, that might indicate buying pressure is building underneath, potentially signaling a reversal upwards. If you, connect this to the bigger market picture, divergence can be really powerful.
Powerful indeed. So if prices are marching one way, but MACD isn't really backing that up with strength, that's a red flag. But like any tool this sophisticated, I imagine there are pitfalls, common mistakes people make.
Oh, absolutely. You definitely need to be aware. One common mistake is entering late. MACD is what's called a lagging indicator, which means its signals can sometimes show up after a big price move has already happened.
Right, you missed the boat.
Yeah, you might jump in just as things are reversing. Another issue is ignoring the bigger trend. MACD signals tend to work best when they actually align with the broader market direction. Using it against a strong prevailing trend can be risky. And finally, be cautious of over-trading small signals, especially on shorter time frames. You'll often find more reliable insights by looking at higher time frames, like daily or weekly charts, to filter out some of that noise, which, raises an important question. How can you refine your interpretation? Maybe even combine MACD with other tools.
And that's exactly what we aim to help you think about. MACD really does seem to offer the best of both worlds, these glimpses into both trend and momentum. It seems incredibly valuable for quickly getting a feel for market dynamics.
It is a very robust tool, yes. But it's crucial to remember no single indicator can tell you the whole story. It's just one piece of the puzzle. Knowledge like this is always most valuable when you understand it well and use it alongside other perspectives, other forms of analysis. So maybe the thought to leave you with is keep exploring how different insights can combine to give you an even more complete picture of what the market's doing.